Now, if the impact of the coronavirus is as bad as markets seem to be fearing right now, will the Fed and other central banks around the world cut rates? And if they do, can they cut enough to rescue the rally? Steve Liesman joins us now from Washington with some thoughts on that. Steve?
Yeah, Kelly, the first one's not a question. Markets are now pricing in a very aggressive Federal Reserve response to the coronavirus as economists downgrade their outlook for U.S. growth. Here are the percentage probabilities. April at a 50% probability. It was July at the 50% probability last week. July now at 85%. And then you start to price in a second cut, where there's a 60% probability for September, and a third cut where there's a 44% probability for December. Ran into Gregory Dacko here at the NABE meeting, who says the Fed will react more quickly to tightening in financial conditions because of the coronavirus than they will to data, which will only show up with a lag. However, former Fed Vice Chairman Roger Ferguson, speaking here, he's now the head of TIAA-CREF, said it's not clear that rate cuts are the right answer.
Here we are confronting, a health issue that may well have a spillover into macroeconomics, but it is not 100% clear that having interest rates, 25 basis points lower is likely to have a direct impact on the ability to manufacture goods or to get people back to work. And that's clearly one of the questions that the Fed has to think about.
Going back to Oxford, they're looking for U.S. growth of only 0.5 point this quarter, just 1.4% for the full year. Goldman also downgrading the first quarter outlook, but sees a sharp rebound in the second quarter. Fed officials, for their part, they've said they would wait for signs that the outlook has changed materially before committing to rate cuts, guys.